Okay, so let us have a look now at a CFA Institute end of chapter question, and the question we're looking at is Quinton Abay. So Quinton Abay, CFA, is an analyst for a private equity firm interested in purchasing big chip enterprises, a conglomerate. His first task is to determine the trends in ROE and the main drivers of the trends using DuPont analysis. So I see that and immediately I'm thinking, well, 3 or 5 stage DuPont, what do they want here? To do that, we've got the data in Exhibit 1. And when we look at the data in Exhibit 1, we've been given revenues, we've been given EBIT, earnings before interest and tax, earnings before tax, and net income, which means we could do either 3 or 5 stage DuPont here. So I'm going to let the questions guide me when I come to them. If I can get away with 3 stage DuPont, it's a bit quicker, so I'll use that. If I can't, in other words, if when I look at the questions it mentions interest burden or tax burden or operating profit margins, then I'll have to do 5 stage. I've got asset turnover and equity turnover there for the years as well. So everything I really need to do is to calculate my return on equity. Then it says, after conducting the DuPont analysis, Abay believes that his firm could increase the ROE without operational changes. So without changing the company's day-to-day business operations. Well, if I'm not changing the day-to-day business operations, then what could I be changing? Well, it must be the capital structure. Okay, and I'm instantly thinking, well, the only real ratio in DuPont that picks up on capital structure is the financial leverage multiplier. Further, Abay thinks that ROE could improve if the company divested segments that were generating the lowest returns on capital employed. Total assets minus non-interest bearing liabilities, and we've also got segment EBIT margins. So segment EBIT margin of 11% in 2020 for automation, 5% for power and industrial, and 8% for medical equipment there. Now, really, the ratio that I would want to compute here, if it's being based on generating the lowest returns on capital employed, then really what I want is EBIT over capital employed. Now, of course, capital employed, they're saying compute it as average assets or assets minus any interest bearing. So you can see it says compute it as total assets less non-interest bearing liabilities. Okay, so minus non-interest bearing liabilities. Well, that's the same as saying take equity plus total debt plus interest bearing liabilities, in other words. Okay, so same thing. Just viewing them as different points on the balance sheet equation. Now, when I look at this, I've got capital employed, I've got EBIT margins, but I haven't got EBIT itself. So really, therefore, I'm not going to be able to do that computation. So I'm going to have to think a bit creatively here when I look at it. He wants to remove the ones with the lowest returns on capital employed. Well, chances are the lower returns are going to be either our industrial or our medical equipment. But we'll have a look at that in just a little while. Abay is also concerned with earnings-based quality, so he intends to calculate BigChip's cash flow-based accruals ratio. Okay, so I'm thinking when I see cash flow-based accruals ratio, I'm thinking, oh, I need to get aggregate accruals, which of course are the accruals-based earnings in the income statement.